Hi, I'm Kenny Klaus, and this is State 48 Homeowner.
Hey everybody, and welcome to the State 48 Homeowner Podcast. And today we're going to dive into see what the market is looking like in fall of 2023. How you guys doing? We got Kraig, Klaus.
Incredibly great, Scott.
And Steve Farrington.
Awesome. What's up, Scott?
What's up? So what is up with the market?
Well, we'll start kind of basics inventory. Right now, we're looking at a tale of two different markets, so to speak. We've got, if you take homes under $1 million, we have about 13,000 active. About 60% of those are under 500,000. About 65% of the homes currently under contract in MLS are under 500,000. Days on market are about 2 weeks longer for homes between 500 and $1 million than they are under, which goes into the stat that you had sent out, Steve, about
first-time homebuyers
that are doing financing make up over about 50% of the sales.
100%, yeah. Currently, and that is the highest level. So 50% of the current market requiring financing on a home loan are first-time homebuyers. So regardless of prices, regardless of rates, they're seeing the value in home ownership. And that's the highest it's been since 2010, when there was a pretty generous tax credit to kind of spur the market back, you know, even though we weren't in a low interest rate environment at that time. So again, very encouraging news, especially first-time homebuyers being 50% of that market.
Right.
Yeah, and you know, when you think of people that are renting currently, the interest rate doesn't mean the same thing.
100%.
As people that are currently in a home and having to trade that lower rate in for a newer one.
Absolutely.
And the rent fluctuations versus the fixed payment, all of that too. Overall, we're up about 27% in inventory since August, but we're down about 22% from last year at this time. We're about 4,500 to 5,000 less active this year at this time than we were last year.
Is this time of year where you see listings dip a little bit, though, as we head into the house?
Typically, yeah. I mean, typically you're going to see, again, I always say in Arizona, we don't have a bad time of the year. Right? Because we don't have snow and worrying about that and that. But, yeah, I mean, you're going to see, you know, early December through about the middle of January is typically the
hunker down for the holidays kind of thing.
It's just a lot of other things going on. Locally, our sales per month are down 21% since August. That means the number of homes that have sold has got nothing to do with prices.
Yeah, transactions.
Right. Basically, nationally, we've got just over 500,000 single-family homes on the market. That's up 1.5% from last week. It's growing faster than last year at this time nationally, not locally, but nationally. Basically, there are fewer sellers now than any recent year. The supply side of the equation shows no signs of easing. So we're adding to it slowly, but that's from lack of demand, more so than anything. That will change, we know, as rates continue or hopefully continue to trend downward. You know, big thing still talks about a lot of foreclosure, you know, all that stuff. Right now, lender-owned or pre-foreclosure make up less than 1% of our total market locally. The share of U.S. home borrowers that were in serious delinquency 90 days or more late dropped to 0.9% in August. That's the lowest recorded since January of 99.
Yeah, some of these are historic lows.
Yeah, and the overall national mortgage delinquency rate 30 days or more late was at 2.6% in August, also historic low. They had an interview Bloomberg did with the Federal Reserve Bank Minneapolis president, and he said, in regards to housing affordability, we have structurally underbuilt the number of units we need to meet our growing population. That's the factor. The interest rate environment will settle over time, but structurally we have to bring a lot more supply online to meet Americans' needs, which again goes back to when we see things start to level again, you've got we don't have enough housing still, and we're still short of housing nationally, locally. All of those things will factor in, so that goes back to, you know, supply demand.
Well, and you've already seen that. I mean, just in the first part of November, the first week of November, with the Federal Reserve holding the Federal Reserve rate steady, with the language that they used in the Q&A afterwards, and then all the Fed speak afterwards, then we've also got some favorable job numbers. Not that, you know, we had misses in added jobs through ADP payroll and the BLS jobs report. So not terrible news, still a good job market, just not hitting those expectations, which is great for interest rates, long-term securities. You've seen the 10-year treasury yield go from almost 5%, now hovering around 4.5%, which is good news for long-term interest rates. I mean, so now instead of 8, we're in the mid 7s. So instead of low 8s, we're back in the mid 7s so far, heading into the middle of November with additional news to come. And just today, as we're recording this, it's November 8th, we had mortgage application data. Just with that little dip of half a percentage point, you had 3% in purchase apps pick up in 4 or 5 days.
Yep.
Refinance apps picked up by 6%.
Wow.
I mean, refinances still make up 100 across the U.S. They're still doing 110,000 cash out refinances a month. People are accessing the equity in their home.
If you're in trouble and doing that and going from 3 to even 7.5 or whatever, but as opposed to taking out a HELOC at 10 or 11.
And that's where those have peaked. I mean, now the teaser rate market in the HELOC has kind of leveled off because the Fed has held that Federal Reserve rate in that 5%, which affects those variable rates a lot more than long-term rates. It's more still inflation for long-term rates and the other economic news. But yeah, so anyways, back on, just looking at long-term interest rates, I mean, we continue this trend. I think that we're probably going to stay in the 7% range as we close out the year and then see what happens as we head into the first part of 2024.
Because they'll react slower going down than they did going up.
Always.
And that just makes
the
sense.
hesitancy of banks and mortgage lenders, yes, we
understand. And they
understand.
know, too, that as soon as there's a 6 in front of them, and everybody with a high 7 and 8 is going to refi, and as soon as there's a 5 in front of them, everybody above that. So they know. And it's interesting how positive data can have such a minimal effect quickly, but then negative data can have such a negative effect quickly.
It's all reaction.
Yeah.
Yep.
This video is brought to you by Klausteam Real Estate Solutions. The Klausteam is different. With the Klausteam, you have someone on your side. Where you live and make memories is important. We have more unique strategies than anyone else to help you accomplish what matters most to you. We can help you with traditional real estate as well as other options such as our lease purchase programs. We can help you buy first then sell, and we can bring you instant offers. We're here to help our neighbors achieve the American dream and help them build wealth through home ownership. For more info or to start your home search, visit us online at klausteam.com.
Well, and, the good news is I remind people, like, a lot of the numbers and stats that we kind of talk about today, maybe a lot of those will down compared to this, down compared to that. So far, home values have been resilient to the increase in inventory. Our average price is a little higher today than it was in August. The average sold price per square foot is about $2 a square foot higher than it was in August. Average days on market has remained pretty steady in the mid-80s. Mm-hmm. That really hasn't fluctuated. It was, I think, 85 in August, 81 today. The list to sale price ratio is maintaining, meaning what they're actually listed for versus what they sell for. We're at about 98%. That's about 1% up from April and about the same as we were in August. So we haven't seen much in that. Cromford, they said closed prices are unlikely to rise much further from this point unless under contract prices establish an upward trend. Given the balance between supply and demand, it seems more likely that under contract pricing will weaken, but we'll have to wait and see what recent moves in interest rates do with buyer enthusiasm. It's interesting, right now the new home market is doing very well.
Sure.
New home market, number of closed sales were up 5% over last year, whereas in resale we were down 12% from last year. A lot of that goes into the incentives they bank into the buying the rate down, doing all of that.
Absolutely.
Because for them, it's about numbers versus profit. I mean, it's more about selling units than it is about profit per unit. And that's where by doing that, they can take a little bit of a loss, but to sell more.
They've got to move inventory.
Correct.
If they have a vacant home sitting there that's completed or near completion, it costs them money.
Correct.
So they'd rather bake in a loan loss and offer a great incentive rate to get a buyer to come in or additional closing costs, whatever they're offering. I think it's a great.
It's great.
If you can take advantage of it, take advantage of it.
Yeah, it's things as a resale seller we can't compete with. I mean, we can't agree to buy somebody's rate down to 4% today. I mean, it's just you don't have that built in that they do. So, but overall, like I said, it's just a very patient market, as I tell people. You just have to be patient because you can go a week without a showing and then have a showing and get a great offer. And whereas before you might have had 7 or 8 showings before an offer. And like I talked about before on here, I would be more concerned as a seller if we were having a bunch of showings without an offer than if we go days on market piling up, because again, for average days on market are 80, then 2 weeks is really nothing. However, if you've had 15 showings in 2 weeks, that's a concern because that the buyer pool has shrunk significantly. So it's more about what are we drawing through there, what is that type of thing, and where are we competitive with other listings that are on the market that are similar. Month supply is increased from like 1.5 to 3 months supply, which means right now we have to really focus on what is our competition. Because if two houses in like yours are going to sell this month, where are we at compared to? Are we going to be one of those two? Do we either have nicer features, something that stands out, or is it price? Were we competitive? And that's how we're looking at it. So again, I think the good news is outside of some unique situations and or areas, prices have held. You're going to get some sellers that after 30 days, they feel like, hey, I'm sitting on all this bonus equity. I just want to get it sold, drop the price, get it sold.
Sure.
So you'll see that occasionally. It'll bring some numbers down, in your neighborhood specifically or in your, area. But overall, prices have remained. And again, they until inventory gets up over 20 plus thousand, I don't see a big
and that
difference.
continues to show in every report that comes out. CoreLogic, Black Knight, Zillow, when you're talking about home prices and home appreciation, really, because not everyone, but the naysayers were saying, we're going to, the crash, and we're going to lose 20% of values this year. The most conservative one I've seen is, we're going to have finished the year at about 2.5% appreciation, and I've seen as high as 6.5%. And this is nationwide, not just our own specific market. So
they've all revised.
To where the average is right around that year for 2023. You should see U.S. home prices appreciate at about a 5% for the year, and
over the next 5 years, it averaged out at like 3.8%. So either way, you're still going to have
it, which is great to see because that adds to the credo that we've been talking about. That because of this lack of supply, the continued buyer desire and demand, home prices are going to hold, home values are going to hold, and the other thing that goes along with that is Fannie Mae and Freddie Mac. We kind of jumped the gun as lenders, because obviously we had to in the last couple of years to stay competitive, is that they've raised the conforming loan limit. We're now honoring $750,000 as the new floor for the conforming loan limit. It's about $24,000 more than it was for 2023, which was $726,200. So even there, they're looking at, okay,
so
home
at like 900 purchase price with 20% down.
About 900.
Yeah.
Right in that, but you're talking, so now you go up to 750, but my point is when you're looking ahead, they don't see home values going backwards or home prices going backwards either. They wouldn't have increased it.
No, and there are some areas that if you look year over year, you're going to see a decline in home values, but if you look 2 years, it's a healthy 2-year increase. You look 3, 4, 5, it's astronomical increase. That you probably shouldn't expect to see long term in real estate.
And I think talking about it in our meeting today, a lot of our buyers agents are saying a lot of buyers are, I'm just waiting for rates to come down. And if we're talking, if you started the year thinking that you lost 5% equity minimum in a house you could have built or could have owned, and if you're waiting on that, guess what? A lot of people are, and guess who's going to come first when rates go from 7.5 to 6.5? Buyers, not sellers.
No, we're not anticipating that there's going to be a huge increase in inventory because
it's going to have to be in the low 5s and the 4s before a lot of people will be willing to give up that shift.
Even in the low 5s, that's a 2, sometimes almost 3% gap between what they're currently in, and that's a lot to get over mentally.
It is, and with prices going up too, and you factor, if you bought a $500,000 house in 2020, now that house you might want to buy, the next house up might be $900,000, and so that then factor in a higher rate on top of it makes it tougher. So the point being is buyers are going to come back first, which means inventory is going to go down, which means prices are going to go up.
Competition and stress as well.
Everything, multiple offers, less negotiating room, less power. That the difference would be is if you were able to get in today, we know or are confident in the next 12 to 18 months, rates are going to be in the 5s, or there should be, that, and you could refi down into that. In the meantime, you've gained 5, 8, 10% equity over that time. And so that's kind of the messaging is, this is actually a very good time to be a buyer right now if you're in it long term. Like if you plan on being in that next house for 3 to 5, 7 years, because you have less competition for homes, you have sellers that have been on the market longer than expected, that are more willing to negotiate in some cases. So you have a lot more leverage, you have a lot more choices, you have a lot more opportunity to get in now, start building that equity, take the opportunity to refi down the road when that opportunity comes, as it always does. And we know, and that's been, I think, the push. And I think you see that a little bit even in the relief we saw last week from 8 to 7.5. We've seen an uptick in showings, homes under contract, things along those lines. So every little bit is going to continue to bring more and more buyers out, which is going to continue to then reduce the inventory.
We've seen it the 2 or 3 times over the last 14 months that we've seen rates tick down by more than a half percentage point. You see that activity in purchases pick up. Absolutely. I mean, it's not dramatic yet, but it's at toes in the water. Okay, now I'm getting in up to my knees. I'm going in. I'm going to let's go look at a house. And maybe they're not ready to buy yet, but the activity always picks up. And I'm just kind of looking forward, the trend should continue as we're starting to see some of these lagging costs come out of the inflationary numbers, which should continue to feed this going forward. I mean, you've got rent and shelter costs are starting to drop, and those are always a lagging factor. So November is usually the first month that we'll see it. We're expecting it. Used car prices came down. The used car index just came out, early November, and those are dropping by 2 to 3%. And those are pretty large percentages of those core inflation numbers that the Fed looks at. Oil. I mean, I put gas in my tank, and there was a 3 in front of. I looked at the pump twice. I'm like, I didn't put in my fuel points yet. So I was a little shocked.
Yeah. And some of that stuff's seasonal, and we know that. And so I just think that if you're on the fence, if you're thinking about buying, the sooner you start talking to somebody, the better, just because you're going to create that opportunity sooner, and you're going to put yourself in a better position, because like we said, when rates drop, we know what's going to happen. We know what's coming.
Well, and we'll see what happens. I mean, the next Fed meeting is right before Christmas. It's December 12th and then the 13th, and that'll be the 13th will be the Fed rate decision, and then his Q&A afterwards. We'll see where he heads out heading into the new year, and then we'll probably have a good 6 to 8 week break before we have any other additional news from the Fed. So as we head into that holiday season is where we'll really kind of either pick up steam, or we're going to take the steam out of where we've seen things go in the early part of November into mid-November and later in the year.
Well, and the good news is there's nothing going on next year that should make anything crazier, like an election or, no, there is.
That's a whole nother podcast.
Buckle in. It's going to be a long 11 months now. So. But no, like I said, I think it's good. I think that, the biggest question now is people ask, what are home values doing? And right now they're holding. There is no indication we're giving anything back significant the rest of this year and into next year as we see it. And home ownership is still the route. It's still what's preferred.
100%.
And if you want to make the next step, you can reach out to us and talk to either of these guys or any of our other agents at 480-354-7344. Thanks, guys.
Awesome. Thanks, Scott.
Thanks for spending time with us this week at State 48 Homeowner, the ins and outs of owning an Arizona home. You can connect with us for more information, submit topics you'd like us to discuss further, and you can see relevant videos, give us feedback, answer your real estate questions, and more at state48homeowner.com.